Okay, let's dig into this. Today, we're doing a deep dive, and we're taking our cues from common sense on mutual funds.
Right. A classic.
Exactly. And our mission, really, is to get a handle on asset allocation, how you actually split your investment money up.
Between things like stocks, bonds, that sort of thing.
Yeah. And the source material really focuses on why this matters so much for you, the investor. It talks a lot about handling uncertainty.
Which the market has plenty of.
Huh, right. And also the impact of costs, which can be, well, kind of hidden sometimes. We're looking for maybe the magic, if you will. Yeah, but not complex tricks.
No, it's about the fundamentals, as the book lays it out. What's great is how it just cuts through all the noise out there. It argues pretty strongly that, real investing success isn't about frantic market timing or finding the next hot stock. It's about structure, efficiency.
And asset allocation is like the main tool for that, for dealing with how unpredictable markets are.
That's the core idea. Think about it. Markets swing, sometimes wildly. You remember 2008, right?
Oh, yeah. Don't we all?
Well, the source points out a good allocation plan isn't about guessing those swings. It's about building a portfolio where different parts react, well, differently.
Okay, so like bonds maybe holding steady or even going up when stocks take a nosedive.
Precisely. The book gives examples, like during that 2007-2009 downturn, bonds actually provided positive returns for many investors. They acted as that cushion.
So it's diversification, but across the big categories, the asset classes.
Exactly. And the source suggests a pretty simple, logical approach, like maybe adjusting your mix of stocks and bonds as you get older.
Right. Younger investors might take more risk with stocks for growth.
Because they have more time to recover from downturns, whereas someone nearing retirement, they'd likely want more stability from bonds.
So it aligns your risk with your timeline and, I guess, your stomach for those swings.
It's preparation, not prediction. That's the key takeaway on handling uncertainty.
Okay, so allocation gives us structure for the market's wild ride. But you mentioned costs, and the source really seems to hammer that point home.
Oh, absolutely. This is where it gets really interesting because the impact is, well, it can be huge over time. The data in the book is quite stark.
Stark how? Like, how much are we talking?
Well, the source shows how costs, management fees, trading costs, things you might not even notice, they just silently drain your returns.
Okay, give me an example.
The book points out, like, an average equity fund might have total costs adding up to maybe 100 basis points. That's 1%.
1%. Doesn't sound like that much in a single year.
Doesn't sound like it, no. But the source shows how that 1% drag year after year compounded, it can potentially slice 10% or more off your total return over the long haul.
Wow. Okay. And it's not just the fee they advertise.
Not at all. Think about trading costs.
So,
the source estimates active managers might spend, say, 0.8% of the value each time they buy or sell a stock.
right.
So if a fund manager turns over their whole portfolio in a year that's 100% turnover, they're constantly buying and selling. That adds up.
So 0.8% to buy, 0.8% to sell. Wait, the source calculates that a fund like that starts year like 1.6% behind the market just from trading friction.
That's the math presented, yeah. Add that trading drag to the expense ratio, and you get what this source calls fiscal drag. It's this constant downward pull.
And the difference over, say, decades.
It's dramatic. The book illustrates this, showing how $10,000 grows very differently. A low-cost index fund, just tracking the market, keeps almost all the market's growth because its costs are tiny.
Okay.
But an average active fund, because of those accumulated costs, the tyranny of compounding, as the book calls it, might only deliver maybe 70% of the market's growth over that same long period.
70% versus nearly 100%. That is quite a difference.
It really is. And it leads to a pretty powerful conclusion in the source material. If active managers as a group struggle to beat the market before costs,
Which the data suggests is often the case.
then the simple low-cost approach, using broad index funds for your stocks, your bonds, whatever your allocation is, becomes incredibly compelling.
So the magic isn't in complex strategies, it's in keeping costs down.
It's about capturing as much of the market's return as you can by avoiding that drag. Efficiency wins.
Okay. So wrapping this up for you, the listener,
Yeah.
what's the bottom line? It seems like the source material is saying a simple, reasoned asset allocation plan, maybe adjusted for age, is your key tool for navigating market uncertainty.
Definitely. Structure and discipline.
And the other really strong message, just unavoidable, is that costs are a huge deal. They significantly erode long-term wealth.
Which is why those low-cost options, like index funds covering different asset classes, tend to win out over time. They just minimize that fiscal drag we talked about.
Which leaves us with a really interesting question, kind of posed by the source material itself. In this world that's just saturated with complex, often expensive investment products, how much real magic is there in all that complexity compared to the maybe less exciting but powerful combination of simplicity and strict cost control when you're trying to build wealth over the long term?
Something to definitely think about.